Hi everyone, in this video we are going to understand how to trade short, how we can make money on the decline in the price of Bitcoin. Basically, a short trade is a trade where you make money on a falling coin. How does that work? How does a traditional trade work? You buy Bitcoin, wait for the price to rise, and then you sell it. The case for shorting, on the other hand, is as follows. You first sell the coin at the current price. You borrow from the exchange to do that. You sell Bitcoin. Exchange pays you immediately USDT, but at the same time, well, or on some other currency, yes, no, the fact that you USDT in a pair, it does. And thus it turns out that you have to return to the exchange the amount of cryptocurrency you sold. After the price of the same Bitcoin falls, you buy this cryptocurrency cheaper, i.e., let's say you sold one Bitcoin at 41,000, the price fell to 38,000, you bought a Bitcoin for 38, returned the debt to the exchange, and thus your earnings are then $3,000. How do you do this? There are two main ways. One I find a little less convenient, the other more convenient. The first way is to use margin trading, which means you go to trade, spot trading, and you select Bitcoin USDT pair, respectively. There is regular spot trading, most likely. You already know how to use it. Yes, there is buying, selling, different types of orders. There is margin trading. You open, respectively. Click next to margin. It is quite a large margin. If we want to do purely without leverage, then we reduce it to a minimum. Let's say 2x's. You can't put less than 2x's. There are two types of margins. Cross margin and isolated margin. You can switch margin types here at the bottom right. You see margin mode, click here. There's isolated margin, there's cross margin. There is also portfolio margin for professional derivative traders. We don't need that. There is no point in even understanding it. If you are a regular user, even signed. You see, a regular user, that is a regular user and a professional derivatives trader. Actually, what is the difference between isolated and cross margin? If you use isolated margin, each margin is tied to one type of coin. So you have Bitcoin on margin, yes, for some amount of dollars bought. If you reach a margin call, it means that the price has deviated, despite your leverage, too much. That is, let's say you were buying long, yes, and the price went 50 or 60% down, yes, Bitcoin started to fall. So, forcibly your trade will be closed and the debt will be returned to the exchange. That's pre-isolated margin. In cross margin, you have a single collateral going on all your trades, meaning Bitcoin you bought, Ethereum you bought, there, Dogecoin, I don't know, Solana, well, whatever, some coins you bought, and you have a single collateral. So, let's say Bitcoin falls in price, Ethereum rises in price, and you have more volume of this percentage by which your crypto assets have to fall in order for a margin call to happen, yes, to isolate, liquidate, or rather, all your transactions, but they are liquidated all at once. That is, you will lose your Bitcoins, Ether in general, all your trades. It is better to use isolated margin, however. Well, this is more of a preference, yes. If you are a beginner, it is better to use isolated margin in principle. If you are trading with large leverage, it is better, of course, to use isolated. But in my case specifically, I use small leverage always. It is more convenient for me. I do not have, in principle, that buy them some super mega volatile coins dangerous. So I have a cross margin and I, accordingly, use it. Here we just set the margin and choose short. Let's say we want to buy Bitcoin and click sell short Bitcoin, that's it. We got the money and the exchange will say that we have USDT on our balance, but we have to pay back some debt. To pay it back, we can either turn off the margin with you, or we can enter the regular spot market. And here we buy Bitcoin after some time the price has fallen. Enter Bitcoin, buy Bitcoin there at the market limit. It doesn't matter. It should be displayed in your account. You can log into your account. And it will be displayed right here in our trading account here. All our information will be displayed here. In borrowing history, it turns out the history of our debts. Yes, we will be able to return here. there will be a button that will allow us to return it in case they will close automatically. It is almost always automatically closed if I'm not mistaken on Diveit. And the second option seems more convenient to me because it is completely automated. There is no need to take something separately and perform a lot of actions. We can just use futures trading for this. We can go to the derivatives section and choose the same pair with Bitcoins, and let's say yes. Here it is. Everything is the same here. That is, here is our margin and so on, but here we can disable the whole letter. Click here. We put the credit on leverage 1. That is, we don't take any margin at all in this way. That is, it is even to some extent a change. Something futures, yes, futures differs usually spot trading. We trade here, contracts directly store cryptocurrency on our account. And well, often up to principle when people hear futures, it is a feeling that's something dangerous because everything is very volatile here. But first of all, why dangerous? Because people there use leverage under 100x, let's say. Yes, and constantly catch liquidation, especially such big long candles down, going example there, or up, actually. There can be short buy, long enter the same amount of 1 Bitcoin. Click sell short, that's it. The transaction is completed. The price goes up, we lose money. The price goes down, we get money. Then just like that, literally in one click, let's say, here I click sell short. Let's put USDT amount here. Let's put 100 USDT right on the example. I'll show you on the click sit short, a window with information pops up already confirming everything is ready. Now it turns out that when Bitcoin grows, we have here our P&L will fall. And when Bitcoin falls, it will rise and then we can close it at any time, let's say at the market, just by clicking the market 100% and confirm. The transaction will be closed very conveniently, very simple. It is even better to use immediately with a checkmark, take profit, stop loss. If we put a checkmark TPSL and you can set some percentages, let's say that we will earn, let's say at 5%. Yes, that is its Bitcoin at 39.36. We will fix 5% of the profit of earnings and the deal will close automatically. And the same thing can be put, I do not know, 10% per minute minutes, 10%. Yes, if here it grew to 45, also the deal will close. We will go minus for what to do immediately. That is, if you analyze somehow or listen to someone can watch the resistance level there, or better if you are basically a beginner there to listen to what some experts say, or even better yourself all of this to get into it. To understand, Zian? It is possible to check the box that more messages are displayed because in fact it is often new time. It is crazy that all this happened instantly without additional clicks. Just clicked everything. Clicked ready. We have added our margin in spite of the fact that we have a loan and in 1 unit. Yes, but if the price rises by 100%, or when it happens, because after all the borrowed funds will be in 8 and 2,000 in this particular case, yes, we will lose money. All put the order ready when the price falls to 30. How much we stood up. It is 39,367 deal will close in the plus. If it rises to 45,500 deal will close in the minus already. So much better to trade. Well and took without leverage respectively. This was the subject of the lesson. Let's close the deal. While the topic of the lesson was about how to trade with us and get some money. Earning some money on the fall of Bitcoin. That's all for now. See you in the next videos. Bye-bye, everyone.